What if I told you that the best time to start investing was yesterday, and the next best time is right now? Whether you're saving for a dream home, planning for retirement, or just want your money to work as hard as you do, investing is the key to building wealth over time. Today, I'll walk you through exactly how to get started with investing, step by step, with stories, tips, and a few lessons I wish I'd known when I began. Let me take you back to my first paycheck. I was excited, but also overwhelmed. Stocks, bonds, ETFs, mutual funds. Where do you even start? If you've ever felt that way, you're not alone. But here's the secret. You don't need a finance degree or a fortune to begin. You just need a plan. Step 1, set your goals. Before you invest a single dollar, take a moment to define your why. What are you investing for? Is it a shiny new car in 3 years? A down payment on a house in a decade? A comfortable retirement in 30 years? Your goals and how soon you need the money will shape every decision you make. Short-term goals, under 5 years, call for safer, lower-risk investments like bonds or high-yield savings accounts to protect your capital. Long-term goals like retirement give you the flexibility to take on more risk with stocks or ETFs, which offer higher potential returns but come with market fluctuations. For example, when I started investing, my goal was to save $10,000 for a dream vacation in 5 years. Knowing my timeline helped me choose investments that balance growth and safety. Write down your goals, including the amount you need and when you need it. This clarity will act as your compass, keeping you focused even when the market gets noisy. Step 2, choose your account. Investing starts with the right tools, and that means opening an investment account. Think of a brokerage account as your gateway to the financial markets. It's where you'll buy and sell stocks, bonds, ETFs, and more. The good news? There's a brokerage for every type of investor. If you love sleek, user-friendly apps, platforms like Robinhood or Webull might be your vibe. Prefer hands-on guidance? Traditional firms like Fidelity or Charles Schwab offer in-person or phone support. Want a hands-off approach? Robo-advisors like Betterment or Wealthfront use algorithms to build and manage your portfolio based on your goals and risk tolerance. When choosing a brokerage, consider fees. Many now offer commission-free trading, account minimums, and features like educational resources or retirement accounts. Opening an account is straightforward. Provide your personal info, link a bank account, and transfer cash to fund it. It's as simple as setting up a new bank account, and most platforms guide you through the process in 10 to 15 minutes. When I opened my first brokerage account, I was nervous about doing it wrong, but the platform's step-by-step prompts made it foolproof. Pick a brokerage that feels right for you, and you'll be ready to start investing in no time. Step 3, set a budget. One of the biggest myths about investing is that you need a fortune to get started. The truth? You can begin with pocket change. Thanks to modern investing tools like fractional shares, which lets you buy a slice of a stock, and low-cost ETFs, you can invest as little as $25 a week, $10 a month, or even $5 per paycheck. For example, if Amazon stock costs $200 per share, fractional shares let you buy $20 worth instead of waiting to save up the full amount. The key to success isn't starting big, it's starting consistently. Small, regular investments harness the power of dollar-cost averaging, where you buy more shares when prices are low and fewer when prices are high, smoothing out market volatility over time. Before you set your budget, take a hard look at your finances. Pay off high-interest debt, like credit cards above 10%. Build a small emergency fund, 3 to 6 months of expenses, and then allocate what you can to investing. Even $50 a month adds up. At a 7% annual return, $50 monthly grows to over $24,000 in 30 years. When I started, I committed $30 a week from my paycheck. It felt small, but seeing my account grow month after month was incredibly motivating. Decide what you can afford and make investing a non-negotiable part of your budget. Step 4. Pick your investments. Now comes the exciting part, choosing what to invest in. The options can feel overwhelming, but let's break it down into beginner-friendly categories. Stocks. When you buy a stock, you're purchasing a tiny piece of a company like Apple, Tesla, or Starbucks. Stocks offer high potential returns, but also high risk, as their prices can swing wildly based on company performance or market conditions. They're best for long-term investors who can weather the ups and downs. Bonds. Bonds are like IOUs you give to companies or governments. In return, they pay you interest over time and return your principal when the bond matures. Bonds are safer than stocks but offer lower returns, making them ideal for short-term goals or balancing risk in your portfolio. Mutual funds and ETFs. These are baskets of stocks, bonds, or other assets, giving you instant diversification. Mutual funds are actively managed by professionals, while ETFs, exchange-traded funds, are typically passive and track a market index. ETFs like the Vanguard S&P 500 ETF VOO or Schwab US Broad Market ETF SCHB are great for beginners because they're low cost and spread your risk across hundreds of companies. Index funds. A subset of mutual funds or ETFs, index funds track a market benchmark like the S&P 500, the 500 largest U.S. companies. They're simple, have ultra-low fees, and historically outperform most actively managed funds over time. For example, the S&P 500 has averaged about 10% annual returns over decades, making index funds a set-it-and-forget-it choice. When I made my first investment, I put $100 into an S&P 500 ETF. It wasn't glamorous, but it gave me exposure to 500 top companies, from tech giants to consumer staples, without the stress of picking individual stocks. That single investment taught me the power of diversification and patience. For beginners, start with ETFs or index funds to keep things simple. As you gain confidence, you can explore individual stocks or bonds. Before buying anything, research the investment's past performance, fees-expense ratios, and alignment with your goals. Free resources like Yahoo Finance, Morningstar, or your brokerage's research tools can help you make informed choices. Step 5. Diversify and allocate. The golden rule of investing is, don't put all your eggs in one basket. Diversification means spreading your money across different asset types, stocks, bonds, sectors, tech, healthcare, energy, and geographies, U.S., international. This reduces risk. If one investment tanks, others can cushion the blow. A simple way to diversify is a 3-fund portfolio. 60% in a U.S. stock index fund, e.g. VOO, 30% in an international stock fund, e.g. Vanguard Total International Stock ETF, VXUS, and 10% in a bond fund, e.g. Vanguard Total Bond Market ETF, BND. Adjust these percentages based on your age and risk tolerance. Younger investors, 20s to 30s, can lean heavier on stocks, 80 to 90% for growth, while those closer to retirement might increase bonds, 30 to 40%, for stability. When I started, I was too focused on tech stocks, and a market dip hit me hard. Diversifying across sectors and adding bonds saved me from future headaches. Use your brokerage's portfolio analysis tools to check your allocation and ensure you're not overexposed to one area. Step 6. Start investing and stay consistent. The hardest step is the first one, but once you've funded your account and chosen your investments, make investing a habit. Set up automatic contributions through your brokerage, $25, $50, or $100 per month, whatever fits your budget. Automation removes the temptation to time the market, waiting for the perfect moment to invest, which even pros struggle to do. By investing regularly, you benefit from dollar-cost averaging, reducing the impact of market swings. When I started auto-investing $30 a week, I stopped obsessing over daily market news and focused on my long-term goals. Consistency, not perfection, is the secret to building wealth. Start small, but start now. Every dollar you invest today is working for your future self. Step 7. Learn and adjust. The market will go up and it will go down. Don't panic. Stick to your plan, keep learning, and rebalance your portfolio once a year to stay on track. Remember, investing is a marathon, not a sprint. Looking back, I wish I'd started sooner and kept things simple. The best investors aren't the ones who chase the hottest stock. They're the ones who start early, stay consistent, and let time do the heavy lifting. Ready to take your first step? Drop a comment with your investing goal, hit like if you learned something new, and subscribe for more tips on stocks, tech, and building your financial future. Remember, the best time to plant a tree was 20 years ago. The second best time is now. Let's get growing.